Learn the latest blockchain news and explore investment opportunities in the crypto market. Welcome to the new world of crypto. Today, we continue our discussion of Bitcoin. Just a few weeks ago, in August 2025, the crypto market was abuzz. Like a bull freed from its shackles, Bitcoin surged past $120,000 and even hit a record high of over $124,000 mid-month. The sky seemed to be the limit, and the fear of missing out permeated mainstream media headlines and social media. Then, like every great party, the music suddenly stopped. A sudden wave of profit-taking sent the market plummeting. By the end of August, Bitcoin's price had fallen back to around $108,000, a drop of over 10% from its all-time high within a month, and a decline of approximately 6 to 7% for the month as a whole. We now find ourselves at this crucial crossroads in early September. The market is filled with confusion, fear, and conflicting signals. Is this a healthy correction in a bull market, building momentum for the next wave of gains? Or is it just the prelude to a larger plunge? Today, we will combine 4 recent reports from Cryptonomist to unravel the mystery and answer 3 core questions. First, what exactly happened in August? Second, where are we now and where are the key battlegrounds? Third, and most importantly, facing the storm ahead, how should ordinary investors craft their own survival playbooks? To see the future clearly, we must first understand the past. August's market unfolds like a classic 4-act drama: breakout, frenzy, volatility, and correction. Act 1. Breakout and frenzy. In early August, market sentiment was high. The report notes that the core narrative at the time was that regulated demand was crushing new supply. Purchases by US-based spot Bitcoin ETFs and publicly listed companies injected significant momentum into the market, pushing prices to new highs. Act 2. Reversal and impact. The turning point occurred in the second half of August. The engine driving the rally suddenly began to slow, even reverse. After experiencing record inflows in July, U.S. spot ETFs began experiencing hundreds of millions of dollars in net outflows in August. Simultaneously, a long-dormant whale transferred a large amount of Bitcoin, causing market turmoil. Act 3. Liquidations and cooling down. ETF outflows and whale activity became the final straw that broke the market's back. The highly leveraged derivatives market instantly amplified the decline. Reports show that hundreds of millions of dollars in long positions were liquidated on several key trading days. Market euphoria quickly gave way to fear. Ultimately, we have arrived at the current situation. After a stress test, the market has temporarily stabilized around $108,000. So, is $108,000 a safe level? To answer this question, we need to introduce 2 key coordinates from on-chain analysis. The first coordinate is the red line, approximately $108,900. This number isn't a line drawn by technical analysts. It's a cold, hard, on-chain statistic called the short-term holder realized price. Let me give you an analogy. You can think of this price as the average holding cost of all recent new investors. What does this mean? When the market price falls below this red line, it means that all the new money that recently rushed in has begun to lose money. This is an extremely dangerous psychological trigger point. These short-term holders have the weakest convictions, and once they suffer losses, they are most likely to trigger panic selling, leading to a larger decline. Currently, we're oscillating around this red line. The second coordinate is the last line of defense, the $93,000 to $95,000 range. If the red line falls, where will the market fall? Multiple reports consistently point to this range, calling it the defense zone. Why here? On-chain data shows a massive concentration of buy orders, like minefields, nestled within this price range. It's estimated that these limit buy orders could total 0.5% to 0.8% of Bitcoin's circulating supply. This area is considered the Maginot Line, where bulls are preparing for a massive resistance. Now that we understand our current position, let's take a look at the weather forecast ahead. This time, the warning comes from a prominent figure, Anthony Scaramucci, founder of Skybridge Capital. It's worth noting that Scaramucci is a long-term Bitcoin bull, even proposing a long-term price target of $500,000. Therefore, when even such a die-hard bull begins to signal short-term risks, we must take them seriously. His warning is stark. Bitcoin could experience a deep correction of up to 40% before embarking on its next long-term bull run. What does 40% mean? If we calculate from its all-time high of $124,000, a 40% drop would bring the price to around $74,000. Even if the price drops 40% from the current $108,000, it will reach $65,000. Both figures are far below the last line of defense of $93,000 to $95,000 we mentioned earlier. This prediction sounds scary, but the report also uses historical data to show that it is not a fantasy in the Bitcoin world. In past bull cycles, 30% to 50% pullbacks were almost physiologically normal. Since 2011, Bitcoin has experienced several bear market plunges exceeding 70% or even 80%. Therefore, Scaramucci's warning is not intended to cause panic, but to remind all investors to be fully prepared for extreme market volatility. In such an uncertain market, the behavior of different players can best reveal the true market dynamics. First, whales are changing positions. A report captured a striking move. A single whale address sold 4,000 bitcoins and exchanged them for approximately 96,859 Ethereum in a short period of time. A single transaction estimated to be worth $435 million. This behavior perfectly reinforces the view expressed in another report regarding internal capital rotation rather than external inflows. This suggests that, even at market highs, savvy whales chose not to cash out, but instead dynamically rebalance their positions between Bitcoin and Ethereum in search of higher relative returns. Secondly, retail investors were treasure hunting. At the same time, another report depicted the behavior of retail investors. When analysts began warning of a potential Bitcoin low, the market responded by viewing it as an opportunity to buy the dip. The market spotlight quickly shifted from Bitcoin to altcoins with greater potential. Various ICO projects, touted as the next 100x coin, began to appear in the investors' field of vision, becoming the most worthwhile cryptocurrency to buy right now. Whales are rotating, while retail investors are treasure hunting. This is the truest portrayal of the current market. So, understanding all this, what kind of survival playbook should ordinary investors develop? Scaramucci's report offers several highly practical suggestions. The first and most important one, make a plan in advance. When the market is calm, plan what you'll do in the event of a crash. Otherwise, once a crash occurs, you'll be swayed by emotions and make irrational decisions like selling at the bottom and chasing the top. The second one, blunt your trading strategies, regular investment. This is the simplest and most effective way to mitigate market volatility. Buying regularly and in fixed amounts, extending your investment cycle, can maximize cost sharing and avoid the risk of being caught in a dagger by trying to buy the dip. The third one, let rules trump emotions, portfolio rebalancing. Set a target position for your crypto assets, such as 10% of your total portfolio. When the market surges and its share rises to 15%, sell the extra 5% to lock in profits. When the market plummets and its share drops to 7%, buy the remaining 3% with cash to lower your cost. This strategy forces you to sell high and buy low, becoming a disciplined contrarian investor. Rule 4. Prioritize core and satellite strategies. Dedicate the majority of your funds, e.g., 80%, to a core position, investing regularly in blue-chip assets like Bitcoin and Ethereum for the long term. Meanwhile, set aside a small portion, e.g., 20%, as a satellite position, maintaining cash and waiting for extreme market declines like 35% or 40% to opportunistically and tactically buy the dip. Rule 5 and a lifeline, maintain sufficient emergency liquidity. Never invest all your money. Maintaining a reserve of liquidity outside your portfolio ensures you won't be forced to sell your valuable holdings due to a desperate need for cash during periods of market panic and rock-bottom prices. The above demonstrates that we are currently living in a time rife with challenges and opportunities. August's surge and subsequent decline have cleansed the market of overheated leverage and introduced a healthy dose of realism. Scaramucci's warning of a 40% correction should not be viewed as a doomsday prophecy, but rather as a stress test exercise. On-chain data clearly outlines the red lines and defenses. In the long term, however, the fundamentals remain solid. The institutionalized ETF channel, the continued accumulation of on-chain whales, and the macro tailwind of the Federal Reserve's impending rate cuts will all propel Bitcoin to new highs. However, in the short term, we must maintain the utmost respect for market volatility. Ultimately, those who will emerge victorious from this storm will not be those who accurately predict the bottom, but rather those who maintain a plan, discipline, and patience for the long term. The above is for informational purposes only, not investment advice. Thank you for your attention.